Good morning. Welcome to the First Home Buyers webinar. For the agenda today, I'd like to update you on the current housing market, tell you about the recent government initiatives to assist first home buyers, show you the steps to buying your first home, and how to make yourself more attractive to the lender. For those looking at buying a property, this is the current median house price and unit prices across the capital cities. Figures for April and May and June indicate that prices have stabilised, with only small increases over the quarter. May and June are generally weaker months for prices anyway. Auction clearance rates have been lower, around 70% clearance. At the peak, the clearance rates were over 80%. Most forecasts are for a slowdown, but not a crash. Here's an interesting graph showing the average years it takes to save for a deposit for a house in the capital cities. No surprise that Sydney and Melbourne are the top two lines. So let me show you this graph on what percentage of new loans are to first home buyers. The number of home loan approvals had fallen 1.9% in April, and the value of loans approved for owner-occupied housing fell 1.1% in April, while the value of loans for investment housing declined 2.3%. Lending to investors are still near 50% but declining, perhaps due to banks having increased rates on investors and interest-only loans by 0.5 to 0.85% in the last 6 months. However, lending to first home buyers are still declining, perhaps due to property prices increasing but income not following suit. The good news is that the recent federal and state budgets have announced assistance for first home buyers. First home buyers will receive concessional tax treatment on contributions by being able to salary sacrifice into their super, and the earnings will also be taxed at a concessional rate. From the 1st of July 2017, individuals can make voluntary contributions of up to $15,000 per year and $30,000 in total to their superannuation account to purchase a first home. These contributions, which are taxed at 15%, along with deemed earnings, can be withdrawn for a deposit. For most people, the First Home Super Saver scheme could boost the savings they put towards the deposit by a fair amount compared with saving through a standard deposit account. This is due to the concessional tax treatment and the higher rate of earnings often realised within super. This measure will assist first home buyers to save for a deposit for their first home faster. In New South Wales, the state government announced a new package for first home buyers, which includes abolishing all stamp duty for first home buyers on existing and new homes up to $650,000 and stamp duty discounts up to $800,000. This can save up to $25,000 in stamp duty. Sweetening the package is a $10,000 grant for those eyeing new homes up to $600,000. As well, the 9% stamp duty charged on lenders' mortgage insurance, often required by banks when lending over 80% of the property value, will be abolished. In Victoria, they have a similar package for first home buyers, where stamp duty is abolished for existing and new homes up to $600,000 and stamp duty discounts up to $750,000. That can save up to $31,000 in stamp duty. Those first home buyers buying or building new properties could also be entitled to $10,000 first home owners grant if the property is in the city and $20,000 for those in regional areas. In the other states, there are some smaller first home owners grants available, but not to the extent of New South Wales and Victoria, although property prices are generally cheaper in those states. For many people, buying their first home will be one of the biggest purchases they ever make, and knowing where to start can feel a bit overwhelming. From house inspections to finding a conveyancer, here are a few steps to take before you get the keys in your hands so you can buy your first home with confidence. Research the market. First, ask yourself what you want to get out of buying real estate. Are you looking for a home in which to live or an investment property? This will help shape the type of research you'll need to conduct. You'll want to get an idea of where you'd like to buy, what the recent trends are in the area and what kind of place you could afford. You can research prices and property values on the internet. Find out how much you can borrow. Your income and expenses will determine how much you can borrow to buy a property. Speak to your bank or a broker to work out your borrowing capacity. You want to get a good idea of your borrowing power early so you don't waste time looking at properties that may not fit your budget. The other thing to take into account is that whilst the lender may be willing to lend you more money, you need to think how the extra payments might impact on your lifestyle. You need to be sure you can afford the ongoing mortgage repayments. As a guide, ideally these shouldn't exceed 30% of your after-tax salary. Another thing to look out for if you're buying an apartment is to check with the lender that they will lend for apartments in that postcode. Some lenders won't lend to high rises in certain postcodes, usually ones in the inner city or where there have been a lot of new apartments pop up in recent years. Some lenders will have a list of developments where they will restrict lending to, so check this before you pay a deposit. Work out the finer details. There are more costs associated with buying a home than just the deposit, including things like stamp duty, pest inspections, building and strata reports in your budgeting will prevent any nasty surprises later. And if it's your first home, you may be eligible for the first home owner's grant or stamp duty concessions. Work out how much you have for a deposit and whether you need to borrow more to complete the purchase. If you've saved the 20%, great, as you've demonstrated to the bank that you are a good saver and you've saved yourself some money by not having to go through the other options. If you haven't got the 20%, you might need to consider borrowing 90 to 95% of the purchase price. This will involve lender's mortgage insurance, or LMI for short. This insurance is to cover the lender for any losses, not the borrower, if you default and the lender does not recover the loan amount. This is requested by the lender when you borrow over 80% of the value or the price. LMI can be quite costly. For example, on a $700,000 purchase, if you borrow 90% or $630,000, the premium is around $15,000 to $17,000 depending on the lender. If you borrow 95% or $665,000, the premium is $29,000 to $35,000 depending on the lender. One way to get around this is for assistance with the deposit from mum and dad. They can either lend you the difference or give it to you as a gift where you don't have to pay it back. Alternatively, if mum and dad have sufficient equity in their home or an investment property, they can use that property as additional security to your loan so that the overall lend from the bank is less than 80% of the total amount of security, and thus waiving the requirement for LMI. This loan scenario is becoming more and more common, especially in parts of Sydney and Melbourne where property prices are higher. However, there are risks involved, especially to the parents when the loan falls into default, and so the banks will require parents to seek independent legal and financial advice before signing the loan documents. Depending on your circumstances, a fixed or variable rate interest rate loan or a mixture of both may work best. The lender or broker can explain the differences and help you identify what's important to you. Variable usually allows you to make extra payments and redraw, whereas fixed rates will protect you from rate rises, but you don't get the benefit of a rate cut during the fixed rate period. Most banks also limit how much extra you can pay into the fixed rate loan during the fixed period. One of the first things you're likely to look at when comparing home loans is the interest rate. While the rate is a very important part of your home loan, there are some important features that can make a big difference and even save you money over time. These features include the ability to vary the repayment cycle. This will help you match your payments with your income. The ability to make additional repayments without penalties. The ability to redraw the extra payments you've made into the loan. Those planning to start a family may find this handy, as they can put extra into the loan and redraw the funds to support the period when there is only one income. And fourthly, an offset account. An offset account is a transaction account linked to your home loan in which you can get funds paid and use it for daily expenses. Have your salary credited to the offset account so that you can get the interest savings as soon as you get paid. If you're looking at purchasing a property, it may be good to get a pre-approval for a loan with a lender so you know that you have the funds to complete the purchase. A conditional pre-approval is an indication from a lender that you're eligible to apply for a home loan of a certain amount. You're under no obligation to take up the loan, and the lender has no obligation to lend you that amount, but it can give you more confidence that you can get the loan up to a certain amount. If you're conditionally pre-approved for a home loan, once you find the place that you're looking for, the lender will verify your financial position and then provide formal approval so that you can make a final offer knowing exactly how much you have with which to bid. No two home buyers are the same, and the amount each person can borrow is different. It all depends on your income, your assets, your living expenses, and the type of loan you're looking for. The next step is to find your home, and you're likely to do the research on the internet. Talk to the agents, friends, and attend many open houses to get a feel of what you want and can afford. Once you find the right property, you will then be asked to make an offer by the agent. The journey from walking through a property at an open inspection to signing the contract and taking the keys varies between states and territories, but typically involves 6 steps. 1. Review the contract of sale. The seller or vendor of a property must have a contract of sale prepared and available for inspection for potential buyers. This contract should include a zoning certificate from the local council, a copy of the title of the property as recorded in the Land Titles Office or equivalent body in your state, copies of documents outlining other registered interests of the property, if any. You can ask to see the sale contract after at least one inspection and discussions with the real estate agent or seller. Review it closely with your solicitor or conveyancer before signing it to ensure it's acceptable. 2. Make an offer. If everything in the contract looks okay and you're ready, the next step is to put an offer in writing to the real estate agent or seller. Your offer should include how much you're willing to pay and any conditions to the sale, such as repairs, deposit amount, or time frame for moving in. Your solicitor or conveyancer can help you prepare the letter of offer so you don't miss anything important. 3. Start negotiating. Your first offer might be accepted right away, but more likely is that you'll have to do some negotiating with the vendor. Once you've reached an agreement, you may be asked to pay a small holding deposit to show that you're serious. While these negotiations are taking place, the seller is free to take expressions of interest from other potential buyers and even exchange contracts with them. If there is another serious buyer, the real estate agent or seller will likely ask you to increase your offer, especially if the other buyer has made a bid. If the seller does accept another offer, any holding deposit you may have is refundable. 4. Exchange and sign contracts. Once you've agreed on the sale price, you exchange and sign the contracts and need to pay the full deposit, typically 5 to 10% of the purchase price. At the end of the cooling off period, your conveyancer or solicitor can help you through this process. 5. Cooling off period. In most states and territories, there's a cooling off period after contracts are exchanged, except when you buy a residential property at auction. During this time, you can withdraw from the sale but may lose your initial holding deposit if you do. Check with the real estate agent or the conveyancer whether there is a cooling off period before exchanging contracts. This can also be a good time to check the condition of the property and, if necessary, arrange pest building or strata inspections to make sure the building and the inclusions are as stated in the contract of sale. If they're not, you may have a solid case not only to withdraw from the sale but to also have your deposit fully refunded. 6. Settlement. The settlement period is typically determined by the seller and set out in your contract, but can be negotiated. Usually it's around 6 weeks. At the end of this period, you pay the balance of the property using your home loan, which your lender will usually do on your behalf, as well as pay stamp duty. You may also get the chance to inspect the property one last time to ensure that all the agreed inclusions are there and the property is in the same condition as when you agreed to purchase it. At the end of the settlement period, you'll receive the keys and the title deed to your new home. Done. Before applying for a loan, there are some things you can do to make yourself more lendable to the bank or lender. Work out where the funds are coming from to complete the purchase. In many cases, it will come from the money you have saved. However, if you have not saved enough, it could mean that you need to borrow more from the bank and hence factor in the cost of lender's mortgage insurance, which is charged when you borrow more than 80% of the purchase price. It may come from a gift from mum and dad, in which case you will need a letter from them to say that they are gifting you the money and it does not have to be paid back. Or they can provide equity from their property as additional security. In all cases, it is good to present a strong case for the lender to lend you the money. Lenders like to see a good savings record, so start showing money going into the savings account on a regular basis. This is especially important if you are borrowing 90% or more, as banks and mortgage insurers will want to see that you're a good saver over a 3 to 6 month period. If you have non-deductible and deductible loans, try to reduce your non-deductible loans first, as the repayments come out of your after-tax income, while servicing for deductible loans come out of your pre-tax income. Banks will assess credit cards at their limits and not the balance, even if you pay it off every month. They also assess it at 36% per annum and is non-deductible interest. Many people today have multiple cards with $10,000 to $20,000 limits, and if you have 2 or 3 cards with these limits, they can really affect your overall borrowing capacity. It would be best to get rid of any cards that you don't use or reduce their limits before application. Once you settle the loan, you can always apply for an increase. The banks now pay a lot of attention to living expenses. In the past, they would just make assumptions on what a single or couple's living expense was based on the Henderson poverty line. These figures were usually fairly low, but banks have now increased these assumptions. However, if you declare a higher living expense, the banks will use a higher declaration. Some might even look at your credit cards and account statements to verify your living expenses. If you take out a loan with an interest-only period, the banks will assess the loan over the remaining principal and interest period. For example, if you apply for a 30-year loan and want 5 years interest only, the banks will assess the loan over 25 years rather than 30 years. This could have an impact on the loan amount you can borrow if the income is tight. So in summary, house prices have stabilised over the past 3 months. The federal and some state governments have announced new schemes and packages to assist first-home buyers. Plan ahead and do your research before you make any offers. There are some good loan offers for first-home buyers. For first-home buyers and those looking for owner-occupied home loans, there are some very attractive variable and fixed rates. Lenders are targeting this market as they want to show that they are helping people buy their homes, whilst raising rates on investors and interest-only loans. For owner-occupied loans with principal and interest repayments, you should be able to get rates below 4% per annum for fixed and variable with a number of lenders. If you haven't been offered these rates, then look around. Talk to a broker. We get emailed latest offers from banks and any changes to bank policy before they get announced, so we can prepare the clients. Many brokers like myself are ex-bankers and know what the banks look for when assessing loan applications and can help make the borrower more appealing to the lender. From my point of view, when I previously worked for a bank, I was only able to offer what the bank had and subject to their policies. As a broker, I have access to all the other lenders and each one will have slightly different policies. So that concludes my presentation. I just want to finish with this disclaimer. Today's webinar was to provide you with more information and should not be treated as advice. You should consult your advice before making any investments. I'll leave you with my contact details. Please feel free to email or call me if you have any queries.